Hello, everyone, and welcome to today's TripleTree Thought Leadership session. Before we get started, I'd like to go over a few items to help you get the most out of today's session. You've joined the presentation listening using your computer speaker system by default. If you'd prefer to join over the telephone, just select telephone in the audio pane and the dial-in information will be displayed. You'll have the opportunity to submit text questions to today's panelists by typing your questions into the question pane of the control panel. You may send in your questions at any time during the presentation. We will address questions throughout today's discussion. I would now like to introduce Michael Carroll. Michael?
Good morning and welcome to Market Insights Live. My name is Michael Carroll and I'm the Chief Marketing Officer at TripleTree. Today's session is focused on the world of outpatient care providers and what's next for multi-site healthcare. We're fortunate to have a great group of panelists today. A quick reminder that the views and opinions expressed during today's conversation are those of our participants and do not necessarily reflect the official policy or position of TripleTree and its affiliates. To begin today's conversation, I'd like to introduce my colleague, Jeff Jones, for opening remarks. Jeff, take it away.
Great, thanks, Michael, and welcome everyone to today's panel discussion. As we've all been experiencing, COVID-19 has had an incredible impact on market activity throughout the last 8 or 9 months, and none more so perhaps than in multi-site and physician practice management segment of healthcare. The impact of COVID has seen volumes reduced tremendously in the first few weeks in particular. The system-wide average was in the 60% range, but there were certain individual segments that saw impact even greater than that. M&A activity has begun to pick up. Over the summer, M&A activity was limited largely to bolt-ons, but we've now seen in the last several weeks more platform investing activity. And then finally, today's discussion, we want to talk a little bit about how the actual deal structure has changed as the environment has evolved with greater emphasis on flexibility and creativity driving unique deal structures. With that, I want to hand it over to my colleague, Michael Huey, to introduce today's panel.
Great. Thank you, Jeff. And just a reminder to our audience, feel free to introduce questions that we can try to weave into the discussion via the chat function. Jeff will collect those and at different times in the conversation, bring those into today's discussion. So welcome everyone again. Thank you so much for joining us in today's episode of Market Insights Live, where we want to dive into issues around M&A and multi-site healthcare. I'm going to be joined by 3 terrific panelists who are going to help us understand from their own unique perspective and lens what's going on in the world of multi-site healthcare M&A. So first, let me introduce the first panelist, Faraz Kamran. Welcome, Faraz. Faraz is a senior partner at Twinbrook Capital Partners. He is a member of the firm's investment committee and focuses on healthcare on the firm's healthcare portfolio. Prior to Twinbrook, Faraz was at Madison Capital Funding, where he founded and ran the healthcare group. Welcome, Faraz.
Thanks, Mike.
Next, I'd like to introduce Chris Werling. Chris is a partner at the law firm of McDermott, Will, and Emery. Chris has significant experience working with private equity and strategic investors, making investments in healthcare and life sciences industries. Chris has significant multi-site healthcare expertise, where he works with physician practice management companies, dental practice management companies, ambulatory surgery centers, and other segments of healthcare services and multi-site healthcare. Welcome, Chris.
Thanks, Michael.
And finally, I'd like to introduce Rob Wilson. Rob is an executive managing director at HIG Capital. Rob runs the firm's Advantage buyout fund and is also the head of U.S. Healthcare. Prior to running the Advantage Fund, Rob spent 10 years as a managing director in both the Advantage Fund and HIG's lower middle market buyout fund, where he's made many investments across healthcare, business services, and technology. Welcome, Rob.
Great to be here.
Great. Well, let's kick off. As Jeff introduced right from the start, obviously, if we go back to the March, April, May timeframe, COVID-19 hit the world with a storm and had particular impact in multi-site healthcare. Let's kick off with a question around what impact did COVID-19 have to businesses in multi-site healthcare, and what did you as equity investors, debt investors, and legal advisors do to work with portfolio companies to weather the storm? Rob, let's start with you and where you focused in your portfolio.
Yeah, so kind of putting myself back in kind of late February, early March. I think the first priority for us as a firm, and in particular for our healthcare portfolio, but frankly across other sectors too, was frankly the safety of our employees and our patients, and just kind of other customers. And so we did a lot to particularly on the physician practice management side, to make sure that everyone feel safe coming to work, and we were doing everything we could to keep them safe. And we were creating a safe environment for our customers. And at that time, we really didn't know what we were all kind of facing. And a lot of states, particularly for physician practice management, they really didn't know how to kind of grade the risk of different types of practices. So everything was kind of almost deemed non-essential unless it was life-threatening. And so there was a point in time where we were operating before that happened. We basically loaded up on PPE. We at the HIG level actually sourced over 250,000 masks for our different companies. And then in addition to that, we had just actually bought or we're in process of buying a glove and cleaning business. So we kind of leveraged that to help our portfolio companies as well. So the first focus was just kind of getting people the equipment. I mean, people were wearing crazy stuff at the beginning when they couldn't get PPE. And then once we got to a point where we felt like people were physically safe, things got a little bit darker, and I think we'll talk about that a little bit today, but we started to shut down a lot of facilities if it was not essential. And not essential took on a different meaning than it does today. But then the second focus was just the financial safety of the businesses and doing everything we could to kind of make sure that the businesses were going to survive. None of us knew how long this is going to last, when we were going to, around the bend. So by mid-March, we drew down the revolvers on almost every one of our companies. Right? So 100 companies drew down full revolvers. We kind of got ready for a storm that we weren't sure how long it was going to last. And then we started to kind of plan for what that looks like for employees and customers, and how we're going to meet their needs, but also how we're going to meet payroll. Maybe I'll pause there so other people have a chance to talk, but kind of happy to keep talking about some of our kind of COVID planning.
Sure. Why don't we jump over to Faraz, because you just mentioned something, Rob, that you drew down the revolver on 100 companies. There's obviously a significant impact to you, Faraz, in your portfolio. Why don't you talk about, and I know we've had some discussion leading up to today about how you've seen different phases of what's happened with COVID, but why don't we start with that first phase back in March and April?
Yeah, absolutely. So, we have approximately 50 healthcare portfolio accounts we took into COVID. Over half of those are PPMs or multi-site. And, kind of building on what Rob has said, what we saw, what I really wanted to see was, look, there's three phases of this. One is, we're not having the hard discussions with the management team or the physicians, having to worry about the safety of the employees. We're a step removed from that. So first and foremost, when we partner with PE groups in all of our deals, we're partnering with people that we hope do the right things at the right times. And so for us, the first 2 months was just stacking sandbags, making sure that the companies were doing everything they could to address liquidity. We have revolvers on every one of our deals, and obviously those are a bit punitive when you draw them, but still better for the company to have that liquidity. Making sure that they were cost cutting where they had to, and really trying to figure out, okay, how long will this last? And so preserve liquidity, cut costs. And then really the second phase that we came into was, okay, and I told every one of my clients, if we have 50 portfolio accounts, we're going to have 50 different discussions. So there is no one size fits all. Idea being is that, okay, when the clinics started opening up again, the world kind of started going into, okay, look, we do have to reopen. One thing we talked about internally, and do people go into doctors' offices because they feel the physicians and the team will be better to disinfect and keep people away 6 feet or what have you, or will it be, I don't want to go there because that's where sick people are? And I think by and large, we've seen obviously people are embracing going to the physician offices because they see that as a more secure setting than perhaps a restaurant and bar. So the second phase after the liquidity phase was, look, clearly there's going to be covenant defaults. That wasn't the most important thing at the time. It was making sure liquidity, oxygen of a company was there. And then how do we, get over these defaults? We are partners to you as, private equity and the management teams. And so we kind of worked a few months of, okay, look, we're in default. How do we fix that? And part of that was, as the world started opening more, the third phase was, look, if you still need liquidity, we put in our revolver, we expect you to put in equity. And part of that could be towards an acquisition. Part of that could be, form of junior debt, whatever you want to call it. But, you have to support the business once we have. And if everything is going along and the world is opening and, you were kind of within a few weeks back to 80-90% of pre-COVID levels, how do we get your platform to kind of turn and become the acquirer of other platforms, essentially getting COVID out of your LTM, if you will? And so that's, again, it was 50 different conversations at phase one, and then another 50, and then another 50. So it's been a lot of, I think, partnership, but I think what's been very positive is that people did all the right things, right? They preserved liquidity, they had the hard conversations, and then they've been partnership oriented to say, look, we will work with you to try to get this in the right place. So I'll stop there, but that's kind of how we've addressed the last 7 months.
Got it. Chris, how about from your side? Obviously, there are a lot of legal ramifications to balance through all this, but in addition to maybe some new topics we haven't touched on yet, some of the funds that became available and may or may not have been good resources for companies to tap into. Can you speak to some of that?
Yeah. Well, looking back at March and April, for a lot of lawyers, it felt like it was raining law. Literally every day there were different regulatory pronouncements coming out, in addition to new bills coming out of Congress. So it was an extremely busy time for us that help multi-site healthcare providers. The initial focus was definitely on helping people navigate those stay-at-home orders and understanding how they could stay open or whether they needed to close down temporarily. But then we quickly focused to helping clients take advantage of the various relief programs. The PPP program started sounding out very promising, but then as the regulations rolled out, it became less and less of an opportunity for most of our private equity funded practice management platforms. Some exceptions there, but the focus then turned to the provider relief program and the Medicare advance opportunity. So, we're still working closely with clients that are working through those programs. Phase 3 of the provider relief program just kind of closed off for new applications. There's reporting going on that's tied to the receipt of those funds. And of course, with the PPP loans, the forgiveness applications are all very live now. So, we are expecting a new round of relief programs after we work through the election process here, and the new House and Senate, gets into session. And part of the expectation is that there will be further relief to the healthcare industry. I think everyone's planning, as we'll discuss, to continue to experience additional cost to provide services, part of which driven by PPE, part of which driven by reduced, capacity in locations. So, we're helping folks gear up for that. I'd touch on kind of 2 other things that were front of mind for multi-site healthcare providers. One which has been very interesting, and I think will have a very much of a long-term impact on the industry, is providers who had not even thought before about providing any element of telemedicine all of a sudden jumped in and moved a lot of their patient encounters to telemedicine. Now, it helped that CMS came out with regulations that dropped a lot of the barriers around technology requirements to be able to provide telemedicine encounters. So it became almost as easy as just using FaceTime to connect with patients. But I think that's going to be a longer term impact of how multi-site weathered this storm. The other area that we were working with clients a lot, which continues to be a challenge, is dealing with physician compensation. And that's an important thing for investors that are listening in today. There was a shock to the system on physician compensation, and some platforms, all platforms have very different comp structures, but platforms that used a base comp methodology with a bonus on top were really struggling with how to adapt to decreased need for physicians in the office. And if you have a base comp methodology where they kind of have a guaranteed base comp, that became a challenge to deal with, and working with physicians to consider temporary amendments and so forth. It was less of a problem for those that had a percentage-based compensation model, kind of more of an eat with what you kill, but it's been a challenge, and I think a lot of platforms are thinking about how do we adapt for the future with physician compensation methodologies.
Got it. Great. Well, we're going to dive into that topic even further here later in the discussion around some of the changes to get into deal making. So that's a great preview there on that one, Chris. I'd like to turn, unfortunately, to what we're seeing in the country right now, which is rising case counts nearly everywhere, and maybe a question of what do we believe is going to be happening this winter, especially with lessons learned around essential services, non-essential services, and how we can best weather the storm. So maybe some prognostications. Rob, can we start with you? What do you foresee this winter, and how do you best prepare with your portfolio companies?
Yeah. So we learned a lot in kind of March, April, and May, and so I think we're all gonna benefit from that. The case counts are obviously getting bad, and it's going to get worse, particularly in kind of where we both are right now in Minnesota, and kind of colder environments where some of the techniques that were being used with doing either certain procedures outside and or using outside and or your cars as waiting rooms to try to lower the impact and social distancing, and the big issue around kind of aerosolization. So really having a kind of a purpose-driven need to be in the building. So I think we've learned a lot of lessons around PPE. I think most people are set up for PPE now, and then in terms of essential, non-essential, that was a big learning. Back at the beginning, a lot of things were just shut down. And I'll use our ophthalmology business as an example. We shut down all but 2 offices, and unless it was a really emergent procedure, we weren't doing it. We had physicians that were kind of scared to come to the office. We didn't want to infect patients, and we wanted to be conservative. And then back then, you might remember Arizona was having a big issue in one of the states that was really spiking. So they shut down anything that was considered non-essential. Now that we've all kind of been through it and assessed what essential looks like, essential is a lot more than just emergency. And so we've now actually gone code by code of if there's another shutdown, what that looks like. And so most of the procedures that we actually shut down, we wouldn't shut down again. So I think that's generally the case. And I think most businesses, other than certain more cosmetic oriented, will probably be able to continue in a way they didn't before because of PPE, because of an understanding of how to protect the environment, how to protect patients, how to protect the caregivers, and then a different understanding of essential, non-essential. Now that's going to be a state-by-state thing in terms of whether shutdowns happen or not. But I think with better, more thoughtful PPE usage, business will be able to continue, but you're going to have to do it in a way that is very thoughtful to aerosolization. And when you're in an environment, even like, PT, for example, that's one that's not considered, essential for a lot of things, unless you just came out of, maybe a surgery and you can't really do some of the things via telemedicine. you can keep a mask on, and I think people can stay pretty safe, and you don't have to worry as much about aerosolization. But if you get into surgeries, unlike where you can't do a local aesthetic, but you actually have to be intubated and you maybe have a tube in your mouth, so aerosolization is a concern. Those procedures get a little bit trickier, and you're going to have to think about ways. You got to add HIPAA filtration, things that probably have happened, but in winter environments where you don't have waiting rooms, you've got more people coming in, and you've got kind of, you know, issues where you can't stay masked. I think that's where there's going to be a little bit more of a risk and going to be a little bit more attention. But we have better answers to it today than we did, you know, 6 months ago. So I think businesses won't go down to 50% or even 20%. You know, they'll go from 100 to, you know, 70 or 80. And people have kind of realized that we got to move on with life, but we got to move on with life thoughtfully. And people will have conversations with their doctor's offices that they never had before about, you know, spacing, time of day, you know, filtration systems. But I think most people have made good decisions that, you know, for the most part, unless you're in a high risk group, you probably will continue moving forward with your dental cleanings, et cetera.
And Rob, remember, you know, those early shutdowns, one of the big drivers was preserving PPE for the hospitals. And so there was a massive, I mean, I think it was clear we as a nation were caught a little bit flat-footed on the PPE front. And so that need has been fulfilled now, and there's greater comfort from the government perspective that we don't need to preserve that PPE, you know, for frontline responders to COVID. So we're hearing from our government contacts that, you know, any future, you know, shutdown orders will be much more, you know, limited, and they're going to give providers discretion to decide on essential, non-essential, which is, you know, a great thing for the industry. We obviously all have to be cautious, but this will allow people to continue to work and not have such a dramatic shock on the shutdown side.
Yeah. Well, let's all hope that more optimistic note's correct, Chris. Actually, looks like we might have a question from the audience, and then we can transition to our next topic. Jeff?
Yeah, so real quickly, from all the panelists, just obviously there's been a lot of disruption to travel and to the ability to interact with your clients. You know, from that aspect of the COVID disruption, maybe you could speak to a little bit around both business development in each of your industries, as well as diligence as you get, you know, much closer to the finish line in transactions. How has the COVID environment impacted the way you do that, and what is, you know, essential, you know, to have that, you know, in-person, you know, discussion or not? Rob, maybe you can go first.
I'm happy to kick that off. So, you know, it's interesting. I think a lot of things, COVID will change things not just temporarily, but permanently. So, you know, I can't remember which of the panelists mentioned HCIT earlier, but we've been using technology and obviously video, Zoom, in a way that we would never have pre-pandemic. And so a lot of diligence has actually gotten a lot more efficient in the amount of touch points that we have, the amount of interactions that we have. It's not just driven by in-person meetings and getting on a plane to do our diligence. So that to me will continue. With that said, we want to shift to more in-person. We've closed, we will this week close our third deal in the Advantage Fund. We've done more in my other funds, but the fund that I run since COVID started. And what I would say has suffered a little bit is the intimacy that you have with the management team. So we're not closing deals without meeting them, but we will have a lot less touch points. So we'll have equal, if not more, touch points if you include video, but in terms of in-person touch points. And I do think that's important, right? You know, these really are partnerships, and you want to get to know people, you want to have comfort with people, and you really want to understand the deals three-dimensionally. So, you know, what used to be maybe call it, you know, half a dozen live touch points, maybe is 2. They're kind of longer and you spend a little more time together, but there are less in-person touch points today. So we're trying to make those a little more impactful. And we're doing enough through Zoom that we feel comfortable, that we've learned enough about the business and kind of the culture of the businesses that we're comfortable moving forward. And so post-COVID, I think there will be a higher bar to jumping on planes and meeting people but it won't be like it is today. I mean, today is exceptionally efficient, but I would say it's it's just a little bit kind of numb. There's not we don't have the connectivity that we used to have, and so I think we'll find a middle ground of both efficiency, but also kind of bringing relationship back into it and making sure that you really have a full understanding of personalities and culture of businesses.
Yeah, I'll just, I think Rob's world needs more interaction, right? Where it's human nature, it's never going to go away. If you're partnering with a management team, especially if they're going to sell and roll over, you need to understand who they are as individuals. If you can work together, I think that is important. We're seeing a lot of our private equity clients, that hit the road a lot earlier. We as a firm have been out of the office since March. I don't think we're back in the office till probably after, March 2021. We've stopped all travel. For us, our clients are private equity firms, and so based on our reputation or market share, we, as PPMs, were even falling out of favor, back earlier in the year at JP Morgan. We've done a lot in that space. We continue to like that space. We've closed a Durham deal recently. We have 3 dental deals that we're basically mandated on, and we're going to close this year. So we're still going into them. I think, kind of to the last question too, we're going to see the slowdown come. We expect it to come, and I think the way we do that is we say, look, the whole reason to have an expertise in a certain sector is we don't have a knee-jerk reaction. And so while we're doing these deals, we're trying to be thoughtful about, what leverage point, what liquidity there is, what could happen in a downside scenario. I think to Rob's point, we don't see it cutting in half again, but, could it be elongated down 20% for 2 months, during the winter months? Absolutely. But one of the reasons to be in healthcare is, look, a lot of these things people do need, right? If you have enough pain, if you have enough of an issue, you will go to the doctor no matter what. You'll try to get in there. So we feel pretty good from a lending perspective that, our portfolio companies will, perform well, and we still like those. And one of the things, we don't do that's held up our portfolio that hopefully will hold it up is a lot of what you saw is the maturity adjustments, right? So doing 2-year, advance of what earnings could be, leveraging that today, we don't have that. And so that's what's allowed a lot of our healthcare portfolio to survive well during COVID.
Yeah.
I'll ask, sorry,
Go ahead, Rob.
One more thing specific to PPM, because I know that's a core focus of the panel here, is a lot of physician ownership. There's different if you have an employed model and you maybe have a single owner or a founder. That can almost operate or feel a little bit more like a private equity deal, private equity. But particularly when you have a PPM transaction where you're partnering with doctors, there is a process. Those deals do not happen overnight, and it takes a long time to get to know the partnership, to feel comfortable with each other. It's not just about the numbers. Very often, the numbers come secondary, so long as you're in the right ballpark, to the relationship, the comfort, what the partnership's going to look like, the doctor comp model that you can, kind of work through together. And so that is harder in COVID. And so we, when I think about our ophthalmology business, I mean, that was a year of courting, and that would have been more difficult in COVID. So you got to be more thoughtful and creative about it, particularly in colder environments where you won't be able to meet outside for the next 6 months, and people will have to kind of get comfortable with meeting inside and how that's going to work. We have done a lot more in Zoom, and I'm surprised with how well I can get to know people via Zoom, but you still have to create those in-person touch points. I think it's particularly important in these doctor partnerships where you're kind of herding cats, right? It's, a lot of people that, they can't meet until 6 or 7 at night anyway. So it's just a very funky environment to build those relationships, and doing those over dinners with town hall type settings is really important. And it's harder in COVID. It can happen, but you gotta work at it in a way that you didn't have to before.
Yeah, Rob, I'm curious, how about your business development folks at platforms that are kind of trying to meet with smaller physician groups? Is that a lot of interruption there?
Yeah, I would say it's similar. That's an interesting one, because a lot of the smaller groups, and I know we'll talk about this a little bit later, the pandemic shook them up a little bit, right? So I think more of them want to sell their business and become a part of a larger platform than they did pre the pandemic. So you've got the issue of they're actually more motivated than they were before because they see the vulnerability of their business and they like the idea of taking some chips off the table and having a bigger partner that can kind of help them focus just on practicing medicine. But the personal interaction of those deals, it's more complicated in a similar way. But you know what I've always said is a pandemic is a terrible thing, but a pandemic with Zoom is a lot better than a pandemic without Zoom. And without Zoom, this would be just a complete disaster across the board. But Zoom has saved, you know, and Zoom like, you know, services like this one have really allowed us to keep business moving. You just have to be more intentional about it. You have to be more thoughtful. And, you know, we actually used to own a private plane business. And we wouldn't use it, you know, because it's just, you know, it's expensive. We want to lead by example. We have done that more now than we ever have to kind of make situations happen. We're really not doing it anymore. I think the airlines have really kind of, you know, done things that have given us a sense of safety. But we did what we needed to do to get in front of people to make sure we were getting deals done. And even with that, our T&A has gone way down just because, you know, instead of making 6 trips, you're making 1 or 2 and you're doing several people at once. So we found ways to do it and, you know, get comfortable that we're making good decisions and building solid relationships. But unlike, you know, a relationship with like Faraz on the lending side, you know, that becomes a little more 2-dimensional. So I think it's easier for lenders not to travel right now. It might be harder on their new business development to start new relationships. But it does become more of a quantitative versus a qualitative exercise where the private equity investment is very quantitative and qualitative, particularly when you get into PPM in founder-owned businesses where they're thinking about what life's going to be like post-close versus just moving on to the next deal.
I think our audience would like to hear about where the 3 of you see more activity happening now and where you expect it to happen within physician practice management in particular. You know, as Jeff alluded to, deals went down to a trickle, but now we're seeing a few more deals. The one referenced by Faraz in dermatology that he just did recently. But maybe, Chris, I can start with you. Are you feeling that there's a shift in focus into which particular physician specialties, and if so, why?
Yeah, absolutely. I mean, I think the Anne Arundel deal that Faraz is a lender to was a little bit unique in this time, in that we haven't seen as much of that retail health trade on the platform basis. But we are seeing increased interest in, you know, the types of practices that are non-retail focused. I think about GI, orthopedic in those buckets. And so it's a little bit of push-pull because while they don't have the retail exposure of, you know, having so many sites, they are extraordinarily complicated deals to get done because of the hospital relationships and the more complicated nature of those businesses, some of them taking risk and so forth. So, you know, we're seeing the interest shift a little bit to that area. I don't think you're seeing a lot of deals announced. I did see Varsity announced a deal this morning, and you know, but I think what those of us on the panel are seeing right now is that there's a lot of work being done on those types of deals. Not a lot of announcements quite yet, but a lot of books in the market and a lot of work being done on those types of transactions.
Faraz, how are you seeing your portfolio likely to shift as you make new investments? And Arundel was a unique situation, but can you comment on where you're expecting more activity?
Yeah, you know, so we are a bit reactive. So we go wherever our private equity clients go. That said, you know, we have 20 plus PPMs in our portfolio that we lead right now. They're across 7 different subsectors. We have physical therapy. We have other kind of multi-site areas. So we kind of go wherever our client wants to go. And like I said, it's more about, is there a good value proposition here? Are you partnering with the seller and the physicians? What does the leverage look like? What do the cash flows look like? And so what we try to do is not be too binary on what we will do, what we won't do. We want to kind of see what the situation is, and sometimes you have to do lower leverage, at least at the outset. A lot of heavy lift, putting in an ERP system, putting in a C-suite, converting from cash to GAAP accounting. So we want to under-lever those, and I think our clients agree with that, because again, you want a lot of rollover as well from the physicians, as well as any other owners, and then they'll use extra leverage as they kind of continue to scale and build the platform. So the only thing I'll say is the specialty bounce back quicker. So obviously ophthalmology, dermatology, GI, those came back quicker than the general dentistry. Some of the physical therapy took a little bit longer to scale. Even the orthopedic platforms took a little bit longer to scale, because you shut down elective surgeries. You actually had people getting into, fewer, the weekend warrior types that are obviously going out and getting hurt. There's fewer of those out there. But again, it wasn't sustainable. And so the question is, could you outlast that? So overall, whatever our clients want to look at, we will look at with them, but we'll hold discipline on, leverage, EBITDA, everything else, to make sure that we are getting something sustainable and what we know is going to be a third wave.
Okay. Next, I'd like to ask each of you about your thoughts on the just ongoing opportunity in physician practice management roll-ups. We've seen some wild successes, we've seen some struggles, and then we also heard from Rob a minute ago that maybe some of the smaller groups are more actively looking for a bigger platform to sell into that might encourage more of these roll-ups. Maybe Rob, we can start with you. What's your prognostication for the ongoing success of PPM roll-ups?
Yeah, I'm a believer that they are here to stay, and I know that that's not a universal thought, because the pandemic is, there's winners and losers right now, and there were winners and losers before the pandemic. There's less winners and there's more losers now as people kind of work through the pandemic, and people were really aggressive in how they were leveraging these things, the add-backs they were doing. I think it was Chris that mentioned earlier too, some of these, companies that have more of a base structure and they couldn't kind of ebb and flow with the volume, had some issues. So I think there's a lot of kind of false negatives and false positives in terms of, are they here to stay? Here's what I'd say. If you built a good asset that's here to stay, these are very different from the ones 20 years ago that were not built to last. If you're just stacking EBITDA, and you're just kind of layering together a lot of different practices in multi geographies, and you're not adding to, better patient care, better, call it, a better environment for doctors, both from a service perspective, making them more efficient, getting more patients into their facilities for them to see every day, helping them both deliver better care, but also make more money. If you're not doing that, and that's not just kind of creating leverage to the payers, that's part of the formula, but it's, are you building a brand? Are you building more efficiency? If you're a surgery oriented business, can you get them out of the clinic more so they can do more surgeries in a day? What can you do to help them provide better care, invest in better equipment, and ultimately just be more efficient? And so if you're doing those things, which very often comes with company building and regional density, if you're doing those things, you're here to stay. These are better businesses, right? When I look at the bunch of the PPMs that we're building and other good ones, Anne Arundel is a great example of a good business. They've got great organic growth. They've got good kind of de novo capabilities. And if you can do that and show regional density, they're here to stay. But this is not a financial kind of engineering game, which a lot of people have approached it. And those are the ones that have gone a little sideways, maybe even before the pandemic, but the pandemic accelerated the problems that they're having. And so that will continue. So I think you're going to have winners and losers. And I think people are realizing you don't dabble in PPM. You got to really be thoughtful about it. This is a unique subspecialty where you've got to really be a company builder and operator. And if you're not doing that and you don't realize that each partnership and comp structure is a little different, and there's each geography, even with the same business, is a little different because the ecosystem of the providers and the brands are different. And so they're nuanced. But if you appreciate the nuance, they're here to stay. There's no question to me that when done right, you deliver better care, your providers will pay more, you have a better mousetrap for the payers. I mean, the payers are willing to pay more. It's not just a leverage game, it's a value add game. You can get into kind of, you know, value-based care versus just fee for service. There's a lot of things you can do. So I'm a big believer they're here to stay if done right.
Got it.
Yeah, the only thing I'll add is, I mean, Rob hit kind of every point on the head as far as this is not 1 + 1 = 2. It has to be 1 + 1 = 3 or more. And it's also not for every physician. And I think that's part of it, is that there are a lot of physicians who want to be part of this type of model because, you know, it allows them to give more care, less administrative burden. But there are other physicians who want to be single shingle or want to be with a smaller group. And that's where, again, you are partnering with physicians here. Your goal is to have them be a partner, be a productive, obviously they are at some level a revenue generator, but they want to be part of the solution. And so that's where, to Rob's point, you need to kind of speak their language. Ideally, it's not you doing it, it's you have someone who's an operating partner or someone who is a physician who's lived and breathed this world, who can go to the physician and say, look, this is what your life will be like, and let's talk about, is this what you want to have, right? A majority, I would say probably 85–90% of the PPM deals we do, our private equity client is the first institutional capital in the deal. So that's why there's a lot of building, right? It's the first time the physicians at some level will be dictated to, as far as, nope, you can't order these supplies anymore, you have to go to this formulary, you can't do this anymore, you've got to stay on this. And they have to know going into it that there will be limitations. Obviously, the physician comp model requires them to take a step back, ideally for a much bigger payoff later. And you have to over communicate that and really spend weeks. Rob can tell you weeks and weeks, running up to the sale, of really being the psychologist to convince them of like, look, this will be better for you overall. But it's scary to give up some of that control.
The one thing that I will just say on the comp side of it is there needs to be an emotional appreciation and an education that if you're a business owner, that there's a difference between the comp you're making as a physician and the comp you're making as a business owner. And the sooner that can be made, the better. And so long as you can build a business that delivers better clinical care and a better comp model than the comp average for that type of physician, right? So whether it's, higher patient volume, better ancillaries, more efficiency, whatever it is, where they're going to make 20, 30, 40% more than their peers because they're running a better business, they're delivering better care, they're getting more patients, maybe they're getting paid more by the payers because of all of that. To me, that's the barometer that you need to meet. And then they also need to appreciate that if they were making way above that, call it 200% of the average, that a lot of that is, as a business owner. And so, it's kind of like, investment bank. When you sell your investment bank, there's institutional capital, and then there's, as a banker, and you need to appreciate that distinction and helping through that education process. But then also, for us, for the physicians that feel like they like the independence, there might be a square peg round hole, but I think for most of them, because we've had a lot of these partnerships, right? And some of them start, kind of kicking and screaming because their partners dragged them into it. But if you're doing a good job and you're delivering, investing in equipment, you're not telling them what formula to use and kind of nickel and diming them over things that they care about, but you're focused on big issues. You have a medical advisory board that's kind of handling the medical issues, and the business people aren't kind of dictating the medical, but you're supporting them and building a better business. For the most part, I've seen most physicians really embrace it, and ultimately they make more money. And so if they're delivering better care and making more money, they're typically pretty happy. And you can find ways to kind of help their ego with buy-in programs and others, so they can say they're an owner of the practice, and you want that buy-in. But net, for the most part, 9 out of 10 physicians that I've come across, if you're doing it the right way, they prefer to be part of one of these partnerships.
Got it.
Yeah.
Let's transition to
Michael, I mentioned, sorry, I wanted to jump in. I mentioned earlier that there's been this focus on comp models and ability to adapt to a COVID-like shock. One of the things that we've been working with more clients over the last few months with is examining the ownership model that's used with different practice management platforms. There are a few platforms out there that use a more local MSO model, where instead of having platform level rollover equity, the physicians have ownership in a MSO that manages their practice or a region that their practice is in. That's the theory behind it is that it ties them more directly to the success and growth of their practice or their region. It is a very complicated structure to deal with, and for us on the lending side, it brings challenges to having subsidiary ownership that has to be navigated with your lenders and possibly even subsidiary distributions, as well as thinking about what are the rights of the physicians with that local MSO equity upon a future exit transaction. But it's been one thing that investors are thinking about, how to more mitigate risk on national platforms and keep that incentive a little more local, is one kind of change that we're seeing a lot more discussion on.
That's great. That's a great entry to where I wanted to try to spend the rest of our time here, maybe about 5-10 more minutes. And that's how are deals changing in this environment, and how do we expect it to change beyond? That's one thing we've been seeing, and Chris, you and I have worked on a structure like that in the past. But what if we think about valuations? Are we seeing a COVID discount? Are we seeing a COVID premium? What is happening for us on the lending side? And what are other creative earnout and other equity structures that we're seeing needed to get deals across the goal line? So maybe just piling on to Chris's commentary, Rob, do you maybe want to give us your view of some of the creative things you're seeing in deal making in this environment?
Yeah, so I'll make a distinction between certain PPM assets and non. We just made a hospice investment, and there's certain kind of post-acute investments, home health, certainly HCIT, and others that are kind of on trend, but are either pandemic proof and or benefit from a pandemic, or of accelerated technology. Those businesses are trading at multiples higher than they did pre-March, right? And so you're seeing an acceleration of trends that will continue. In the PPM specifically, I would say that the multiples are actually fairly neutral. I mean, pandemic proof is kind of a new part of all of our vernacular, right? It's not just kind of, is it seasonal, is it cyclical, customer concentration, payer concentration, those all exist. But how can it weather the storm? How can it survive another wave or another pandemic? People think about that now. I think they're a little less worried about it than they were in March. So I think the valuations that we're seeing are fairly neutral to where they were before. There are certain segments of the environment, and Faraz can probably comment on it more because I think they're in dental and PT and others that have a little more of a W recovery. Those are having a little more of an issue because it's a longer recovery, and people are a little more worried about the essential nature of it and kind of the rebound. And it's not huge. It's not like they're off by 50%, but if you're off on volume by 10%, your EBITDA is going to be off by more than that typically. And so there's a little bit of the W recovery ones that have a little bit of an impact. But in general, I think valuations are holding up, but there is more of a winners and a losers. It gets back to the conversation we had earlier. Is I think people have a heightened sensitivity to, are you stacking EBITDA, or are you really building something that's thoughtful and built to last? And you're starting to see that in how they perform in this environment versus kind of, playing a game of whack-a-mole because you got a bunch of different assets in 10 different environments with all different brands and different ERP systems. And you're exposed, the problems are much more exposed. But for ones that are performing, I think they're generally in line with where they were before. And the bigger issue now is the EBITDA disconnect, right? So it's, their EBITDA was probably higher in LTM February than maybe it is now. And so can they get a full value? Are they ready to go to market? That's where, and can you sell off a run rate? And so if you can't, I think that's where the multiples aren't different, but it's off what EBITDA, and can they get credit on the full run rate? And if not, and Chris can probably tell you more about this, I think we're getting a little more creative on structuring and getting back to pre-pandemic levels and or even some growth, which you have to be careful about, kind of Stark and anti-kickback, but the MW team is pretty thoughtful on that. So making sure you're not foot faulting on those issues, but being able to kind of match value expectations with where the current performance is, and particularly with many people and lenders' concerns around second waves. We're also building in, I'll just mention one more thing, some kind of second wave protection with some of our lenders, so we don't kind of foot fault out of the gates over the next 6 months.
Yeah, the way we're looking at it is, I think that's exactly right. Coming out of 08, 09, there were businesses that were deemed either recession-proof or a V-shaped recovery very quickly, and those were at a much higher premium. So I think part of this is like, okay, how diverse is your practice? What regions are they in? How supportable is it? Is it more retail? Is it prevention, or is it really something that you need to have done? It's cancer related or something that really can't wait too long. And it's the valuations haven't moved too much. It's based on what EBITDA. And the way we've looked at it is, we've said, look, we aren't giving just random COVID add backs to our portfolio or any deals. We want to look at each scenario and say, look, are you 80% pre-COVID? Are you 90% pre-COVID? Where are you at? Is that sustainable? Has that been sustainable for 6 to 8 weeks minimum for us to say, okay, now this is the new normal of this business? And then can we take that new normal for 3 months and annualize that to come up with, okay, this is now what we think is a supportable lender's EBITDA. And then, the other things you were seeing is, you were seeing PPM deals going into 6 times leverage on a unitranche or 6.5 times leverage on a unitranche. We weren't doing that pre-COVID. Obviously, we're not doing that now. You have a lot of lenders who've left kind of doing PPMs in general, but other lenders have come into it. So I would tell you, I would say leverage on PPM deals has come down, half a turn to 3/4 of a turn, depending on the situation. But the multiples have held up, and really it comes down to, is this EBITDA defendable? How do we grow into it? What other investments have to be made? So it is being thoughtful. And then look on the covenants. I think, most of our covenants, we have 2 covenants on every one of our deals. They're usually set between 25 and 30, maybe a little higher than 30%. And the idea being is like, look, we get it, right? We get the equity thesis here. We get the idea that there might be a second dip, but depending on how we structure these, we need to just take that into account for setting the covenants, whether it's a portfolio company doing a large add-on or it's a new LBO platform, that we have to walk the line between defending ourselves and our balance sheet and our fiduciary responsibility, but also exactly what Rob said, right? We just paid all those fees, we just did all this, and now 3 months later, 9 months later, we're back to the table because we had this massive issue. I think there's a middle ground there. We obviously find it with a lot of clients, but it's a little bit more nuanced now than it was pre-COVID.
Got it. And Chris, I've heard you talk about maybe some more creative ways for there to be earnouts or other incentives around some of the owners to stay. Can you comment on some of the terms you've seen introduced there, or maybe a little bit new in this environment?
Sure. Yeah, I've spent almost 20 years in healthcare services deal making, saying no to earnouts. So this is an exciting thing for us to be able to bridge that valuation gap. I'll say I'm not really seeing it on platform size deals right now, but most significantly, we're seeing on add-ons, bolt-ons. In those transactions, it's really difficult to figure out, like Faraz referenced, the kind of lender EBITDA. It's very difficult to figure out an EBITDA for valuation because you had this big jolt in March, April, May. So one of the things that we've gotten comfortable with under anti-kickback and Stark is a contingent payment type model, where in the year or 2 following the close of the transaction, you have a portion of the consideration that was held back and is paid based on achieving some type of threshold. The preferred threshold that we're using is RVU threshold, if that's relevant to the business. Some revenue-based thresholds have been used as well. We don't encourage the use of an EBITDA-based threshold. One is it's extremely complicated. Second is there's a little too much of a risk of shift towards more profitable procedures and services, which when dealing with Stark and anti-kickback, you don't want to build a holdback that overly influences clinical behavior. So we prefer a RVU or a revenue-based threshold target. You do have to carve out a lot of ancillaries from those targets under the Stark law, but on purely physician-performed services, we're seeing that get done. Kind of percentage that's being held back tends to be in the 20 to 30% range in these holdbacks that we're seeing. The other thing, Michael, you mentioned is just other types of hooks. I mean, it's one of the most challenging parts of getting, particularly a platform deal where you're doing a partnership with a larger group practice is some of the terms around their equity and some clawbacks on that equity. So I do see investors taking a harder look and thinking about taking a much harder line on kind of equity clawbacks in the event that they depart the platform earlier. Some of those clawbacks being some more punitive terms too, because people are concerned there's going to be some uncertainty in the world over the next few years, right? And so we don't want, as investors in a platform, you don't want that uncertainty to trickle into having second thoughts about whether people are at the right spot as a provider, and want to be, if you're going to decide to do this partnership, you're in it together for a long term. So how do you build the right incentives for people to stay through, even though it might be a little bumpy? You're going to be investing in improving their business. You're going to be navigating some challenging times together. You don't want them to depart at the earliest available opportunity.
All right. Great. Well, gentlemen, we're just about out of time. Maybe final question, lightning round, 5-second response from each of you. 2021, next year, with COVID on the rise right now, but people getting settled into the new deal making in COVID, are we going to see more platform deals in physician practice management and multi-site more broadly in 2021 versus 2020, or will we see less deals? Let's go quick round robin.
I'll say more.
Go ahead, Russ.
No, I'll say more. I think there's a lot of pent-up demand. I think that people are gone fishing for a long time, and as Chris and Robin mentioned, at the end of the day, people have realized what limitations are from their capital base, and so I would say more.
Yeah, so I think it's probably more too, maybe slightly tweaked to the reasons, a lot of deals that want to get done this year couldn't get done because of this value disconnect that we talked about. And so despite higher taxes, COVID, second and third waves, I still think more are gonna happen next year, because you're not gonna have these huge dips and people having the big disconnects around how you value these PPM assets.
Yeah, and I'm consistent there. I think we will see more in 2021. Do you think the interest is going to shift to orthopedic, ENT, GI? And we haven't spoken about it much here, but I think there's going to be massive interest in multi-site behavioral healthcare and providers there, which are going to have massive demand needs. And that's a type of provider that can be coupled with a great telemedicine platform. So looking forward to a busy 2021.
Perfect. Well, thank you to the three of you for your perspectives, and thank you for the audience for joining in today. With that, we're going to conclude our panel discussion, and I'll be now turning it over for some final comments from my colleague, Michael Carroll.
So that concludes today's Market Insights live session. We're actually taking a few weeks off, and we'll come back right after beginning of December, on just Tuesday, December 1st, where we'll talk about healthcare mergers and creating winning combinations. For more information about all of the Market Insights live sessions, you can visit triple-tree.com/Market Insights Live. You'll see replays from our former sessions, as well as then the opportunity to register for upcoming sessions. Again, I'll just add my sentiments. A huge thank you to our panelists today. Great conversation, great perspective, and wishing everybody a great rest of the day. Thank you.